Guys, how many stocks do you need to have in your portfolio? If you ask to 10 different investors, you have 10 different answers. Let me give you mine in this video, so let's dive in! Diversification is a word that we hear every time in the investing world, and many believe that this is the only way to protect yourself against risk. However, when we listen to Warren Buffett and Charlie Munger, his business partner that many consider as clever as him, diversification is a protection against ignorance and makes very little sense.
In wealth management, a lot of people think that if they have 100 stocks, they're investing more professionally than they are if they have 4 or 5. I regard this as insanity, absolute insanity. I find it much easier to find 4 or 5 investments where I have a pretty reasonable chance of being right that they're way above average. I think it's much easier to find 5 than it is to find 100. I think the people who argue for all this diversification, by the way, I call it de-worsification, and which I copied from somebody, and I'm way more comfortable owning 2 or 3 stocks, which I think I know something about and where I think I have an advantage.
As a small investor, if we are interested about above average results, should we avoid putting all our eggs in one basket? Or should we put our eggs in one basket and watch that basket? And I believe that it makes more sense to have a focused portfolio, which means less than 10 stocks, if you are a small investor that is investing in individual companies. And there are really 3 key reasons that make me believe that way. The first reason, and it will be surprising to you, is because it actually limits your risk. The second reason is because your money works more aggressively for you. And the third and final reason is because it makes your workload more manageable and maximizes your effort to result ratio. Let's go through each of those points one by one to get them better. Diversification says that spreading your investments across different industries that have low connections to one another reduces price volatility. The idea is that if you mix things up, you are less likely to experience big drops because as some industries might go down, others might go up. And this provides a more consistent overall portfolio performance. However, volatility does not equal risk for long-term and value investors. When you know what you own, a down market is something really good because it gives you the opportunity to buy wonderful companies for less than they are worth. While volatility is not risk, a down stock that could hit the ground is something that you should be concerned about because risk comes from a permanent loss of capital. A permanent loss of capital is when you lose the money that you initially invested. Because in investing, your losses have a bigger impact on your portfolio than your wins. For example, if you have $100 and you lose half of it, 50%, you will need to make a 100% return from your $50 to get back to your $100. And this could happen easily if you do not understand the business in which you put your money in. Unfortunately, diversification greatly increases the chances that you will put your money in something that you do not know enough about. Managing your risk in investing often relates to what do you have instead of how many do you have. The only way to avoid permanent loss of capital is to buy wonderful companies, pay them less than they are worth, and keep them for a long period of time. In addition of properly managing your risk, a focused portfolio will increase the productivity of your invested dollars. When you know that you can only have 10 stocks in your portfolio, it pushes you to be more selective. If you are more selective with your picks, you will most probably raise the qualitative criteria by which you will select your stocks. And being selective will enable you to allocate your money wisely because your dollars will be put on your best ideas. Warren Buffett often says that with each investment you make, you should have the courage to put at least 10% of your net worth in that stock. Because the best way to fast track your wealth creation is to put big bets on your best investing ideas. And when you do so, you concentrate your money in companies that have the highest probability of delivering above average performance. To provide you an example from real life, let's look at the French Soccer League. I know that many of my friends won't like this example, but this is the best I found. Let's say that we are in 2010 and you have to pick the teams that will win the league the most during the next 10 years. Each time you bet for the right team on any single year, you make money. When we look at the winners from 2010 to 2020, why would it make sense to bet on other teams than PSG if you are really serious about making money? I hope that this example helps you to better understand my point. Investment portfolios that obtain the highest returns for investors are often not widely diversified. Those with investment concentrated in few companies are better at building wealth, because diversification often equals average results. If your portfolio cannot really go down if you are diversified, it cannot really go up as well. In investing, people would often assess their performance by comparing how well they did against the market. A study from the book The Warren Buffett Portfolio that Charlie Munger recommended shows that if you have a 15 stock portfolio, you have 1 in 4 chances to beat the market. But if you have 250 stocks in your portfolio, your chances are 1 in 50. The ride will be bumpy if you have few stocks, but you need to cope with this bumpiness because in the long run, your portfolio performance will more than compensate any market fluctuations. In addition to creating above average results, owning few stocks will also enable you to have fewer headaches because your workload will be more manageable and you will be in a position to maximize your effort to result ratio. The more companies you have, the more time you will devote on research and monitoring those stocks. By increasing your workload, diversification could put more pressure on you. If you are conducting your investment practice on your own, on a part-time basis, you have limited time and efforts. As a small investor, using your time and efforts efficiently is key to your future investing success. Having less than 10 stocks in your portfolio will maximize your effort to result ratio. All investment portfolios require some time and some efforts to research companies and monitor them. Each of these time and efforts will bring different results. If you want to be efficient, I do believe that your investment portfolio should require you the minimum time and efforts and produce the maximum results for you. Having a small number of outstanding businesses that will do well in the future is the only way to achieve that. Before to conclude, I would like to show you a short video clip of someone that highly contributed in creating the devices that you are probably using to watch this video. I'm talking about Steve Jobs, and he was the best to embody this idea of focus in the business world.
Focus is about saying no, and the result of that focus is going to be some really great products where the total is much greater than the sum of the parts.
This is it for today, guys. I hope you liked this video. If this is the case, feel free to drop a like, and if you want to receive more contents like this, feel free to subscribe. Thank you all, see you next time, and peace out.